Back again, or maybe you see me on TikTok. But I'm back again with another dividend paying stock and wanted to see if I'm going to add it to my portfolio.
Dividend investing is kind of fun in the fact that it is a positive action, meaning a company is giving you money. You can either reinvest it or you can just keep it in cash. You typically, somebody who's closer to retirement will probably keep it in cash and use that as kind of an income source. But a younger person, a lot of times you see them reinvesting and they get so excited.
Now, if you didn't know, I'm trying to build my portfolio for my bridge account. So this isn't my retirement account. So this is an individual stock. Now, before you get into this video, understand what a dividend paying stock is, and here's a video.
Understanding dividend in 1 minute. Imagine owning a potato farm. You start with 50 potatoes and seek help from your friends for 50 potatoes more. After harvesting 200 potatoes, you keep 100 potatoes for replanting and you distribute the remaining potatoes amongst your friends. Similarly, company distribute a portion of their earnings to shareholders as dividend. These are the portions of business earning or profit that are distributed to the owners or shareholders as a reward based on their ownership share or contribution to the business.
Now that we know what a dividend paying stock is, let's go into why I'm getting into dividend paying stock. It's because I want to build my passive income without getting into my goose egg. And this is a reason why, and here's a video of why I am picking dividend stocks. And
never buy a stock that doesn't pay a dividend. That has been your advice through and through. Why are these stocks more attractive?
You look at companies that don't pay distributions, don't return capital, how risky they are. Take a GoPro, for example. I'm not just picking one company, I'm just giving you a good example of a company that basically has lost 70% of its value, never returned a dime to shareholders. Or how about a company that's been around much longer, Yahoo? Never paid a dividend. It's never made money for anybody except all the CEOs that have gone through there and got whacked.
see that? That's a passive income. And the reason why I am analyzing these companies for a long term is
I think the reason so many scum buckets are making so much money is because you're buying stupid courses over and over, thinking there's some magic formula for passive income. Passive income looks like this. You take money that you can afford to go to zero and you put them in the two places that have historically created passive income. Public markets that you don't care if it goes up and down and you just wait to the end, or real estate. And you hope that your real estate area doesn't get crushed. Everything else almost doesn't exist.
because of what Warren Buffett said. And when I read The Intelligent Investor, and this is what he said.
And predict the stock market. And then I read Ben Graham, when I was 19 or 20. And I realized that I was doing it exactly the wrong way. But it didn't hurt that I had that background and everything. I rejiggered my mind and when I read the book, The Intelligent Investor. And from that point, I never bought another stock. I bought businesses that happened to be publicly traded, but I became an owner of a business, and I did not care whether a stock went up or down the next day or the next week or the next month or the next year.
Now that we got all that out of the way, let's go into what's my requirement and why I'm doing this. Well, why? Because I'm building a bridge account. I am considered coast fire. That means I saved enough in my 401k and my Roth that I now need to branch out to something else. I'm continuing investing in my Roth IRA. And if you don't know what a Roth IRA is, and here's a video about it. Now, my Roth IRA, I'm still continuing to max it out every year, but I don't max out my 401k contribution because I only do the match. So I need to find a way to somewhere to put my money. And where I'm going to put it is into this bridge account. And since my bridge account is something separate, I wanted to try building my own portfolio. Now, eventually I'll put this on a spreadsheet so people can keep update with it. But right now I'm still building it. It might take me a year, might take me 2 years to figure out exactly what I want in my portfolio. And it's going to take some tweaking, a few years to figure out. So stay tuned and enjoy the journey. And what are my requirements? Number one, I need to see that it is a dividend paying stock. Why have it in my portfolio if it's not a good dividend paying stock? Number two, it has to be financially sound, means they have to have good profit and have good growth potential. So, and number three, they have to have some. And number three, they have to have possibility of growth. This is for the long term. And number four, I want to have ownership in the company. Why would I want to own a piece of a company just for the profit? Well, because I want money. But then I don't know anything about the company. It makes no sense. So I want a good, solid company that I would agree to have or have part ownership. And this is what I'm doing. Now, the company I'm looking at today is this company right here. So they look like they're a healthcare provider company. They do health insurance.
Elevance Health Incorporated, formerly known as Anthem Incorporated, is a health company headquartered in Indianapolis, Indiana, United States. It is an independent licensee of the Blue Cross and Blue Shield Association. Through its family of companies, Elevance Health provides health benefit solutions through a broad portfolio of integrated healthcare plans and related services, along with a wide range of specialty products, such as life and disability insurance benefits, dental, vision, behavioral health benefit services, as well as long-term care insurance and flexible spending accounts.
And I could go in here and review what they're going to tell me what there is, but I figure something out. I can go and take the shortcut and go to Wiki, because I'm not here to make it too complicated. So I'm going to check what Wiki says about it. Wiki says it's an American multinational health insurance company. Prior to June 2022, it used to be named Athena Corporation. So they used to be, and they rebranded. So, all right. Now I know who they are. They're a health insurance company. And if you don't know what a health insurance company is, here's a video of it so you can get a better understanding.
College and got her first job at Corporate Co. The job is great. Free food, friendly colleagues, and even a health insurance plan. However, there's just one problem. Susie has no idea what health insurance is, or even if their plan is right for her. What should she do? Well, her first step is simple. Understand how health insurance works. Like all insurance, in return for a monthly fee called a premium, health insurance reduces the costs associated with a risk, in this case, excessive medical bills due to sickness or injury. However, unlike other forms of insurance, health insurance premiums are unique. They're only based on a few factors, like age, location, and smoking habits, and not on your health status. That means if you have a pre-existing health condition, like diabetes or asthma, your insurer cannot raise your rates or deny you coverage. This is undeniably great for the consumer, though health insurance also has a few problems, mainly the confusing jumble of terms. HMO, deductible, the list goes on and on. However, Susie shouldn't worry. Explained properly, health insurance isn't all that complicated.
But that's a health insurance company. While you watch that video, I was going through the history of it. It looks like a pretty decent company. And I also went through and looked at what else they were doing, such as their growth. Now, Wiki only has up to 2022, and their revenue looks like it has been increasing, and so has the employee. But this is only up to 2022. So let's go into MSN. I like using MSN. It's the easiest one, and it has almost everything I need for free. So I recommend using MSN because they have a bunch of hints on what to do. So let's check the performance. How has it been doing? This is one of my criteria to see how they're doing performance-wise. Year to date, they're negative 3.78. Okay, maybe there's a reason why we don't use it against them. 1 year, they're down 17.57%. Maybe it's a good time to buy because it's dropping right now. And you want to try to buy a company while it's dropping so you can take advantage of the performance when it increases. But there might be more to it. So 3 years, they're down 30.60%. And 5 years, they're up 19.47%. It looks like they took a big hit. And might be due to COVID. Might be due to something else, but let's do the research on it and see how they're doing with their dividend pay. Well, on here it says it pays a 1.96% dividend yield, but let's go ahead and go to stock analysts and see what they say about this. So the stock analyst says 1.93%. They pay $6.84 annually, and they've been growing their dividend for 14 years with a dividend growth of 6.12%. That's not bad. I would like to see a longer term for dividend paying, but it does look like it's been paying out pretty steadily, and that's not bad. Well, so it meets one of my criteria. It pays a dividend. I'm not looking for a crazy amount of dividend. Some people has a certain percentage. I just want it to pay a dividend. Even if it's 0.1%, it pays a dividend because I'm looking for more for the growth. So let's look at the finance. Are they financially healthy? Do they have a good growth profit? So according to this, 2023, it made $171 billion and went to $176 billion. And what I like to do, if you don't know what revenue is, go ahead and go to this little icon right here, and it tells you what it is. This is why I like using MSN. So if you don't know something, just go over here and it'll tell you. And then what I also like to do is look at the margin analysis, gross margin, operation expenses, operation income, and net profit. Well, they don't give it to us for the gross margin operation expenses, but their net profit is only 3.38%. I really don't like that net profit. Doesn't mean I won't buy them, but I prefer to see profit in the 10 percentile. Personally, it does across all board. Now, it might be impossible in some industry, but hey, it's my portfolio and I want this criteria. This way, your portfolio should meet your criteria. Now, let's look at the balance sheet. Let's see. They have $40.37 billion in intangible. This is asset that is not physical in nature, such as goodwill, brand recognition, intelligent property. So they're worth about $40 billion. And they have $29 billion in long-term debt, which it increased their debt from in 2023 to 2029. I don't like that. They increased their long-term debt by $6 billion. And shareholder equity jumped up to 41% or 41 billion. The biggest takeaway from this for me, I don't like seeing company increase their debt year over year. And this is what it looks like to me. Every year it's increasing their long-term debt. That to me is not sustainable business from my business experience. Well, let's look at the cash flow. So, operation cash flow, it takes $5.74 billion to run it, and they did drop it from 2023. Okay, that's good. And then free cash flow. That means how much money they had left over. $6.7 billion, and it dropped down to $4.49 billion. Now that to me tells me it's not financially secure enough for me. They're not making the money that they're saying they're making, because you can make this look however you want based off how you want to put your books. Now, it's called a little bit of manipulation. If you don't look into it, you will fall for it. So for me, it doesn't pass the financial secured part because it looks like they're increasing their debt. Maybe they're doing it for a certain reason, and I have to do my due diligence. But at the end of the day, it doesn't look like it's going to be financially secure. So I also like to see what investors are getting into this and who's in this company, just so I can reference if I know any of them and if I like their investment strategy. I do like seeing BlackRock in it, State Street, JP Morgan, Bank of America. I like to see some of these places when I purchase these stocks just because it helps me understand that even they think it's a good asset to have in their portfolio. Top sellers, I don't recognize any of them. And let's go to the company and see what's going on. I'd like to do this portion to see if there's a lot of people selling their stocks from insider because they know more going on than I do. Now, it's okay if they sell, but if everyone's selling, it kind of looks weird to me. So you have to use this as a grain of sand. So he bought it. Grant, bought. So it looks like everyone's buying. And granted, so looks pretty good on that part. So the other thing I do like using is AI. Why? It's because we're in a digital age and MSN gives us AI and gives us the number for AI. So let's look at the evaluation, 5 out of 6. Earning, 4 out of 6. Future growth, 3 out of 6. Historical performance, 1 out of 6. And financial health is 1 out of 6. And let's look at why the valuation, 5 out of 6. It looks like it's keeping up with all the other big health insurance company. So that's good. And the PE multiply in that industry is in a good range. So the value of the company is a good standing. Now, earnings. The peer average is a negative 39. So they're doing better than most of their other competitors. So that's good, but doesn't mean I want them because I'm looking for companies that has some value that I can keep and make money. Future growth, it looks like it's average within the industry if we compare it to everyone. And historical performance, it makes sense, but it looks like United Healthcare Group is doing way better. And financial health, I agree with it. It's a 1 out of 6. It's not doing too healthy. So, I think about this stock, it's a no-go for me. I'm not going to buy this stock. The performance is bad. The dividend payout is nice, but the health of the company does not look like it's going to be worth it for me. So it doesn't do my performance. It doesn't do my financial health. And it doesn't seem like a company I want to own. So it doesn't meet all my requirements. So I will not be buying this stock. Now, should you buy it? I'm going to tell you, do your due diligence. But my recommendation is no. So you do what you want. Like and subscribe to my video. And that's all I got for you.